Hello everyone. I will continue with the rest of chapter 4 in this lecture. So now we look at different techniques available for loss forecasting because it is important to analyze the loss and that will help you adopt suitable risk management techniques. So some of the techniques used in enterprise risk management are probability analysis, regression analysis, and loss distribution. Probability analysis means we are using likelihood of occurrence of an event to find out their occurrence. So two events can be independent. That is, they can occur independent of one another. In that case, if you are looking at simultaneous occurrence, we will do a simple multiplication of their probability. You can refer to the example in this. If the events are dependent, then we can say that if event 1 occurs, it also has an impact on the probability of event 2. In this case, if you are going to find their simultaneous occurrence, we will take the probability of occurrence of one event and the probability of occurrence of the second event given the first event has. So we will use these two probabilities to find their probability of simultaneous occurrence. So you can refer to the example in this slide. Then we have mutually exclusive events. That is, either one of event will happen. In this case, if you want to find the probability of occurrence of either event, we will do a simple summation of their individual probability. Then we can also use regression analysis. So this is a functional relationship between two variables. So if we know two or more variables, so if we know the value of one or several variables, we can use those values to predict the value of a single variable. So that single variable which is predicted may be related to loss. So we know different factors and based on that we can predict the occurrence of loss. Okay. For example, in this case, we are looking at the payroll and its relation with workers' compensation. There is a functional relationship in form of a linear function, and that can be used to predict the workers' compensation. Loss distribution is a probability distribution. So in this case, we'll have a table where we will get the value of the probability of loss given other factors. So these are some of the ways to forecast the loss. But companies as well as insurers are using different financial techniques. So it is important to look at some of the concepts in financial analysis. So the first thing is time value of money. So cash at present can grow in future. So it will grow due to compounding of interest. Similarly, cash available at future can be discounted and its present value can be found uh, compounding of interest. So how do risk managers apply this concept? So they have to do capital budgeting where they try to find out whether it is profitable for the company to invest in a certain project. So they try to find the net present value. So it is the sum of the present value of future cash flow minus the cost of the project. So if the net present value is positive, which means it makes sense to invest in a certain project. Okay? There is going to be positive outcome in the future. Internal rate of return is a related concept. In this case, the company tries to find an interest rate for which the present value of future cash flow is same as the cost of the project. So that gives an idea of what is the minimum rate of return required from a project. There are other risk management tools available, like risk management information system, risk management intranet, and predictive analytics, which companies can use, which insurance companies can use to do better forecasting as well as selection of suitable techniques. Value at risk involves calculating the worst probable loss in a given time period. Based on that, the company can allocate funds to cover those losses. And finally, we have catastrophe modeling. If you remember, catastrophic event means a large number of customers face losses. Generally, in case of insurance, we assume that if 100 people are going for insurance cover, maybe 5 of them will face losses. So the loss of 5 is distributed among 100 because everybody is going through it. So that is a normal scenario. A catastrophic scenario would be 80 or 90 among the 100 are facing losses. So that requires a different technique for analysis as well as forecasting. That can be done through catastrophe modeling. That's all for chapter 4. Thank you.